Hi everyone, welcome back to Rich Mind Channel. You know, I've been in the real estate game for a long time, but I've also spent my fair share of time in the stock market. And one thing that always gets me is how many people lose money. I'm talking about a staggering 90% who end up in the red. So, in today's video, we're diving into why 90% of people lose money in the stock market, and more importantly, how you can avoid making the same mistakes. By the end of this video, you'll have a solid understanding of the common pitfalls that trap most investors, and hopefully, the knowledge to navigate the market more effectively. So let's get started. Alright, Chapter 1. Chasing quick profits. This is probably the #1 mistake I see people make. They hear about some hot new stock from their barber or their uncle at Thanksgiving dinner and they think they're going to get rich quick. They FOMO in, buying at the peak, only to see the stock plummet a week later. Let me tell you a quick story. Back in the day when I was just starting out, I got caught up in the hype around a penny stock. Everyone was talking about it, saying it was going to the moon. I ignored my own research and poured way too much money into it, thinking I'd make a killing. Guess what? The stock crashed and burned, and I lost a big chunk of my savings. It was a painful lesson, but it taught me that there are no shortcuts in investing. The real money is made by investing in solid companies with strong fundamentals and holding on to them for the long haul. Patience, my friends, patience. Slow and steady wins the race. Moving on to Chapter 2. Lack of knowledge and research. This one goes hand in hand with chasing quick profits. A lot of people jump into the stock market without really understanding what they're doing. They don't take the time to learn about different investment strategies, analyze financial statements, or even understand basic financial ratios. It's like trying to fly a plane without taking any lessons. You might be able to get off the ground for a little bit, but you're bound to crash and burn eventually. I remember when I first started investing, I was so overwhelmed by all the information out there. I didn't know where to start, so I just kind of winged it. Big mistake. Luckily, there are tons of resources available these days. You can find books, articles, YouTube videos, online courses, you name it. The key is to find resources that resonate with you and your learning style. Learn the basics of investing, like how to read a stock chart, understand different financial ratios, and evaluate a company's financial health. The more you know about investing, the better equipped you'll be to make informed decisions and avoid costly mistakes. Alright, Chapter 3. Emotional trading, fear and greed. This one's a real killer, guys. Emotions can cloud your judgment and lead to some seriously bad decisions in the stock market. Fear can make you sell your winners too early or hold on to your losers for too long, hoping they'll bounce back. Greed, on the other hand, can make you chase after risky investments or hold on to a stock for too long, even when all signs point to a downturn. I've been there myself. I remember one time I was up big on a stock, but I got greedy and didn't sell. I thought it would keep going up forever. Well, it didn't. The key to avoiding emotional trading is to have a plan and stick to it. It's also important to remember that the stock market is a marathon, not a sprint. Let's move on to Chapter 4. Poor risk management. This one's crucial, guys. You can be the best stock picker in the world, but if you don't manage your risk properly, you can still lose everything. Poor risk management can take many forms, like investing all your money in one stock or sector, not diversifying your portfolio, or using too much leverage. It's like putting all your eggs in one basket and then dropping the basket. I learned this lesson the hard way early in my real estate career. I put all my money into one big development project thinking it was a sure thing. Well, the project went south and I lost everything. The key to effective risk management is to spread your investments across different asset classes, sectors, and geographies. This way, if one investment goes south, it won't tank your entire portfolio. It's also important to only invest money that you can afford to lose. By managing your risk effectively, you can minimize your losses and protect your hard-earned money. All right, Chapter 5. Trying to time the market. This one's a fool's errand, guys. Even the most experienced investors can't predict with certainty when the market will go up or down. Trying to time the market is like trying to catch a falling knife. You might get lucky a few times, but eventually, you're going to get cut. I used to think I could time the market. I'd read all these articles and watch all these experts on TV, and I thought I had it all figured out. But I quickly realized that no one, and I mean no one, can consistently predict market movements. The best approach is to invest consistently over time, regardless of what the market is doing. This is known as dollar cost averaging, and it's a great way to reduce your risk and take advantage of market fluctuations. Over the long term, this strategy can lead to significant wealth accumulation. Remember, time in the market is more important than timing the market. On to Chapter 6. Following the herd. This one's all about peer pressure, guys. You see your friends and family getting into a certain stock or investment and you don't want to be left out. So you jump on the bandwagon without doing your own research. Following the herd can be dangerous because it often leads to buying high and selling low. By the time everyone and their grandma is talking about a particular stock, it's probably already overpriced. And when the market inevitably corrects itself, you're left holding the bag. I remember when everyone was going crazy over cryptocurrency a few years ago. People were quitting their jobs, taking out loans, and investing everything they had in Bitcoin and other digital currencies. I got caught up in the hype too, and I invested more than I should have. It's important to do your own research and make your own investment decisions based on your own financial goals and risk tolerance. Finally, Chapter 7. Ignoring the power of compounding. This one's a real shame, guys, because compounding is one of the most powerful forces in investing. Compounding is the process of earning interest on your interest. It's like a snowball rolling downhill, gathering more and more snow as it goes. The longer you let your investments compound, the more money you'll make over time. I've seen the power of compounding firsthand in my own investments. The key to harnessing the power of compounding is to start investing early and invest consistently. The earlier you start, the more time your money has to grow. Even if you can only invest a small amount each month, it will add up over time. Don't let procrastination rob you of the opportunity to grow your wealth. Thank you for watching. I hope this video has helped you understand why so many people lose money in the stock market, and more importantly, how you can avoid making the same mistakes. Remember, investing is a marathon, not a sprint. If you found this video helpful, give it a thumbs up. Share it with someone who might benefit. And don't forget to subscribe to Rich Mind for more insights and tips to help you succeed. Thanks for watching until the end, and I'll see you in the next video.